UK property experts are predicting that UK house prices are likely to fall by as much as 10 to 15% next year as mortgage deals are pulled from the market and increasing interest rates are rising to levels not seen since the 2008 financial crisis. But before we jump into the main meat of this video, please remember to hit that subscribe button, hit the like button, and of course share with anyone who you think will find this video useful. Since the start of the year, mainly in the last couple of weeks, there have been nearly 300 mortgages pulled from the market by banks and building societies, triggered by a fall in the pound, which in turn is causing expectations for mortgage rates to exceed 6% in the first half of next year. Nationwide was in fact the first big lender to increase its interest rates on mortgages on their fixed rate deals. Its 2-year rate has risen to 5.59%. Just 3 months earlier, for comparison, it was offering a comparable mortgage at an interest rate of 2.54%, showing just how much interest rates are actually increasing. There has been worry that the increase in interest rates is going to cause forced selling, with there currently being 2 million borrowers on fixed rate mortgages due to expire between now and the end of 2024. However, this fear is mostly overblown because most people are still on fixed rate mortgages, and it's going to take some time for the increase in interest rates to actually pass through the market. But what is going to impact the market in terms of these increasing interest rates is people's ability to buy due to less affordability. Currently, there are roughly 3,596 residential mortgage deals available, which may seem like a lot. However, for comparison, at the end of last year, there were 5,315 residential mortgage deals available, showing just how many are being pulled from the market right now. Combine this with a general feeling of stress, people are unsure what is actually going on. What should they do and how are they going to afford to get through the winter? Now, to put these mortgage rate increases into perspective, people who agreed mortgages 5 years ago will have done so at rates of between 1 and 1.7%. Those people will now have to remortgage at about 4.5 to 5%, which could equal as much as £500 to £600 in extra monthly payments. And according to RightMove, first-time buyers are paying average monthly payments of £1,057, which will increase to £1,114 a month if lenders pass on the recent half-point interest rate increase. In May of last year, a borrower with a 75% LTV could have got a 2-year fixed-rate mortgage at 1.5%. The rate for the same or comparable mortgage product right now is 4%. And by early next year, we could see these kind of mortgage products hitting 6% interest rates. So, what are experts expecting is going to happen? Well, the guys over at Credit Suisse have warned that we could see a fall by as much as 15% in property asking prices. Why? Higher interest rates, inflation and recessionary risks. Rising interest rates push up mortgage rates, which means the amount of money a lender can actually offer is reduced, and you have a reduction in buying power, which can cause property prices to fall. Remember, for every 1% increase in interest rates, on average we see a 5% fall in property prices. But despite all of this negative news, both in the political realm and economically, house prices actually continue to increase month on month in September, with house prices gaining an average of £2,587 in value, bringing the average cost of a property here in the UK to £367,760. And for right now, prices could continue to go up thanks to Kwasi Kwarteng announcing last week that no tax will have to be paid on properties up to the value of £250,000, and for first-time buyers, the threshold has now been increased to £425,000. Now, although this could lead to property prices to continue to go up in the short term, much like what happened last time when they reduced stamp duty, you are artificially propping up property prices, which just delays the inevitable. Now, this change in stamp duty could increase the number of first-time buyers, which is what it's planning to do, but this is in the short term. First-time buyers are still going to have to compete with higher interest rates and in turn higher monthly payments. Not only that, interest rates could actually just continue to go up. So when the next round of fixed rate mortgages expire, you could end up with more people not able to afford their monthly payments. That's all from me, guys. I hope you found this video useful. If you did, remember to hit that subscribe button, hit the like button, and share with anyone you think will find this video useful as well. Thank you, and I will see you in the next one.